Markets don't respond to truth. They respond to when truth is delivered. And in financial history, the most dangerous moments often arrive wrapped in the most optimistic headlines, the kind that feel reassuring, the kind that arrive when confidence is already stretched thin. What unfolded in silver today wasn't a failure of the metal. It wasn't bad timing, and it definitely wasn't chance. It was a carefully timed liquidity event, executed when belief was strongest and caution was weakest. If you bought silver today because the headlines told you the rally had only just begun, this analysis is for you. This isn't hype. This is how markets actually work. Part 1. The Wednesday Liquidity. Flush. If you entered silver this morning after scanning the news, here's the uncomfortable reality. You weren't early, you were providing the exit. Yesterday, the market lit up after one of the most aggressively bullish silver outlooks in years hit the wires. Bank of America, one of the most powerful financial institutions on the planet, published a research note suggesting silver could push toward $39 per ounce. That single number spread instantly. Social media, newsletters, trading desks, inboxes, it was everywhere. Retail traders felt the pressure immediately. If silver is heading there, I can't afford to be late. So when the market opened on Wednesday, January 7th, demand rushed in. Buy orders stacked, momentum traders chased, price surged aggressively, ripping higher to 82.75. On the surface, it looked like confirmation. A clean breakout, the opening act of a move toward triple digits. And then, right as excitement peaked, the door slammed shut. Selling didn't trickle in. It didn't hesitate. It hit the market like a hammer. Silver didn't pause. It fell apart. By the afternoon, price had collapsed to 70.1854, down 262 on the session. That's over a 3% drop in a single day. Anyone who chased the breakout near $82 found themselves down roughly 5% in just hours. This wasn't an accident. This was a textbook sell the news event. The bullish report wasn't a green light. It was a warning. Institutions used the surge in optimism to unload inventory onto traders, reacting emotionally to the story. This playbook is old. What happened today was a flawless execution of it. In this emergency breakdown, we're going to unpack exactly how this unfolded, why major banks tend to publish bullish forecasts near short-term peaks, and how to navigate volatility like this without getting shaken out, because the headline promised continuation. The chart delivered reality. Part 2. How big money walks away. To understand today's move, you have to understand how large players exit positions. Picture a hedge fund that accumulated millions of ounces of silver back around $60. With price near $80, they're sitting on enormous gains, but they can't simply dump their position. It's too big. A blunt exit would crush the market before they're done selling. They need demand, a lot of it, and nothing creates instant demand like a powerful headline. That's where the Bank of America report fits into the puzzle. Whether intentional or coincidental, it triggered the perfect liquidity window. Retail traders saw the upside projection and rushed in. Buy orders flooded the market right at the highs. And the professionals quietly stepped aside. They sold into strength. They sold into enthusiasm. Retail demand absorbed institutional supply, and once that demand was exhausted, price collapsed. That's why the reversal was so violent. This is distribution. Late buyers replacing early holders. The phrase is old because it's accurate. Buy the rumor, sell the news. The breakout was the rumor. The price target was the news. The result was the flush. Now let's look at what the chart is telling us. Markets remember pain. Just last week, December 29th, during the thin liquidity of Ghost Week, silver spiked to 83.71 before getting slammed. That was the first rejection. Today, January 7th, price rallied again, this time topping at 82.75 and failed in nearly the exact same zone. That's a classic double top. On a chart, it forms an M. In market psychology, it signals heavy overhead supply. Sellers are aggressively defending the $83 area. Every approach triggers selling pressure that overwhelms buyers. Until 83.71 is decisively broken, any breakout narrative remains stalled. Silver is boxed in. The ceiling is clear. The floor is now being tested. Gold reinforces the message. Gold is trading around 44.50 thrice, down roughly $32 on the day, about 1%. Silver, meanwhile, dropped more than 3%. That divergence suggests broad selling pressure, likely tied to rising bond yields. When yields climb, paper gold comes under pressure, and when gold sells off, silver feels it more intensely. That's the downside of leverage. On the way up, silver amplifies gains. On the way down, it amplifies fear. But here's the key detail. Gold is still holding the $4,400 level. It hasn't broken down. It's consolidating. That tells us today's silver move was likely exaggerated. an emotional washout rather than a structural failure. Gold stayed composed, silver panicked, and that sets the stage for what comes next, the psychology behind extreme price targets. Part 3. The technical damage. Now we step away from headlines and face the only thing that ultimately matters, the chart. This is where opinions die and price speaks. In this section, we're going to break down the technical damage from today's move, dissect the rejection near $83, mark the support levels that must hold into tomorrow, and answer the critical question every trader is asking right now. Is this the start of a trend failure or a classic bear trap? Because narratives don't move markets. Price does. If you're technically inclined, today's silver chart is uncomfortable to look at. We just printed a large red daily candle. Price failed to maintain altitude above $80, and the structure on the screen is starting to resemble something traders fear, a textbook double top. So in this part of the emergency breakdown, we're stripping away speculation and focusing purely on price action. I'll explain why the rejection at $83 matters, outline the danger zone between $75 and $78, and show you why, despite the ugliness of today's candle, the broader structure still argues this move is a shakeout, not a breakdown. Short term, the chart looks bruised. Long term, it's still under construction. Let's draw the lines. From the bear's perspective, the argument is clean. On December 29th, silver topped at $83.71 before getting slammed. Today, January 7th, it rallied again, this time to $82.75, and failed in nearly the same area. Two highs, same zone, same rejection. That creates what technicians call an M-top or double top. In classic technical theory, this pattern signals buyer exhaustion. It suggests strong supply above 82 and insufficient demand to punch through. If fully confirmed, price would be expected to fall back toward the neckline, and that neckline sits near $70. That's why fear is spreading online. On paper, the chart looks bearish, but that interpretation ignores context. In inflationary supercycles, textbook patterns often break down themselves. Double tops frequently evolve into high handles. Instead of collapsing, price moves sideways. Supply is absorbed gradually. Sellers distribute inventory over time until there's nothing left to sell. And when that happens, price doesn't respect the pattern. It explodes through it. That's what this looks like right now. The key is volume. Yes, selling volume increased today, but it wasn't panic volume. It closely matched the volume seen during the advance. That tells us this wasn't fear-driven liquidation. It was controlled profit-taking. Now focus on the behavior around $78.40. Every dip into that zone attracted buyers. Price didn't cascade lower. It stabilized. We're hovering near 78.5, not accelerating, not unraveling. That matters. High volume without downside follow-through is a signature of accumulation. Weak hands are being forced out. Strong hands are stepping in. Institutions didn't chase silver at $80. They waited. They let the flush come to them. And institutions don't trade silver for $2 flips. They position for cycles. So where is the real line in the sand? The battlefield sits between $75 and $78. $78 is immediate support, the former breakout level from earlier this week. Holding it shows resilience. $75 is critical support. It capped silver throughout December. Old resistance becomes new support. Every major participant is watching that number. Banks, algorithms, physical buyers, everyone. A daily close below 75 would be a warning. That would signal a failed breakout and open the door to a deeper correction. But as of now, price is still several dollars above that zone. A 3% drop feels violent. A 20% buffer is not. Now let's check momentum. Yesterday, daily RSI was approaching 80. Deeply overbought, the engine was overheating, it needed relief. Today's sell-off delivered that reset. RSI cooled into the 60s without destroying structure. That's constructive. Markets don't move in straight lines. They surge, pause, reset, and then continue. Ironically, today's decline may have saved the rally by preventing a blow-off top and replacing it with consolidation. Consolidations are dull, but they're durable. Gold supports the case. Gold is down roughly 32ers, less than 1%. It remains near all-time highs in a strong uptrend. Silver dropped harder because silver always does, but silver cannot enter a true bear market while gold stays bullish. The math doesn't allow it. The gold-silver ratio widened slightly, making silver cheaper relative to gold. That draws in ratio traders and value buyers. Gold is acting as the anchor, keeping silver from drifting too far. So yes, the chart looks ugly, but the structure remains intact. Which brings us to the decision point. Part 4, the recovery strategy. This is the final chapter of this emergency broadcast. We've broken down the sell the news flush. We exposed how liquidity was harvested. We mapped the technical damage and identified the support zones that matter. Now you're watching silver hover near $78 and asking the only question that counts. Is this the end or just the shakeout? In this final section, I'll lay out the recovery framework. I'll explain what matters over the next 48 hours, why this Friday's weekly close outweighs any intraday volatility, and give you the final verdict on the $39 target. Because the trap was triggered, but that doesn't mean you're the one trapped. In professional markets, amateurs obsess over opens. Professionals study closes. The spike to $83, the plunge to $78, that's noise. The trend is defined by the weekly candle. We have 2 sessions left, Thursday and Friday. The setup is simple. If silver closes the week above $75, the weekly candle prints a long, lower wick with a solid body. That signals the breakout survived. Volatile, but intact. Algorithms read that as bullish continuation. If price is forced below $75 into Friday's close, that confirms a failed breakout and opens the door to deeper downside. So lock your focus on $75. That level separates a dip from a trend failure. Given physical tightness and gold's resilience, probabilities still lean bullish. Now let's address the number everyone keeps mocking, $39. At $78, it sounds absurd. But you must separate destination from timing. Bank of America didn't say silver would hit $39 this week. They said the fundamentals justify it within this cycle. Did those fundamentals change today? Solar demand didn't vanish, debt didn't disappear, mines didn't suddenly double output. Nothing changed except sentiment. This was emotional damage, not structural damage. Emotion fades, math doesn't. If you bought silver for the long-term thesis, a $2 drop is irrelevant. That's turbulence, not a crash. And here's the hardest lesson in finance. Sometimes the best trade is doing nothing. In violent whipsaw markets, trying to outmaneuver every move usually ends badly. The market is engineered to punish overactivity. If you hold physical silver, you're already outside the casino. Let them trade. You own the asset. And if you're holding cash, this isn't a failure. It's an opportunity. Any price between $75 and $78 is a gift. This is a retest of support in a confirmed breakout market. Waiting for $60 is waiting for a past cycle that no longer exists. So here's the final verdict. Yes, the headline created a trap. Yes, liquidity was extracted, but the bigger reality remains unchanged. Silver is structurally undervalued, supply is tight, institutions are repositioning. The road to triple digits isn't smooth, it's hostile. And today, we took a hit, but the line is still holding. The thesis remains intact, and the advance continues. Defend $75, ignore the noise, and remember why you entered this trade in the first place.